Welcome to the Chamber Music Mindset. My name is Anna Rathben. I am your host and the founder and CEO of Granadilla Advisory. Now, we're recording our fourth episode. Very exciting. We're getting this off the ground. But I do need to remind you that none of what you're going to hear in the content is investment advice. It is really for information purposes only, just because I love communicating this stuff to anybody who is willing to hear it. Okay, so let's start out today with some of the things that we learned last week. And I know I ended last week talking about the things that we were looking forward to, in particular, international trade, PMI numbers, where it's a diffusion index. Above 50 is expanding. Below 50 means that the economy is contracting, all of those things. Now, I have some updates for you. So let's start with international trade. One of the things that I said last week was, with all this tariff going on, maybe there's some changes to international trade data. Normally it's not that exciting, but it has become exciting. Well, the number came in. It is less negative and more in line with the recent trends before the tariffs began. Now, let me back up and give you a little bit of context. Looking at the past 20 some odd years, international trade, while boring, follows a certain kind of a trend. So establishing a baseline, we're almost always negative. Like, I shouldn't even say almost. We're always negative international trade. It's because we import more than we export. America is a land of consumers, so we buy from other countries. Also because we're the wealthiest nation on earth, right? So we're almost always, say that again, almost, we're always negative. So the question really is just how negative are we? So let me go back to maybe 2009, because that's a nice place to start. After 2009, the Federal Reserve cut rates to zero. A lot of you may remember that. And therefore, the value of the dollar against other major currencies fell. And when that happened, well, other countries, people with other currencies were like, oh, well, the dollar's cheap. Let us buy U.S. goods. So international trade became less negative. Okay, so it was a little bit higher on the graph. And then during the pandemic, when we were on our couches shopping online, I did that. I know my husband did that. Certainly things started to appear in the house. That meant that we were importing a lot more, and the international trade really dipped. It dipped down. And then as the Fed raised rates, because some of that was the culprit of the inflation that we experienced, along with the supply chain disruption. And then we saw two wars rage on. The dollar became stronger and stronger and stronger. So that was rising rates and uncertainty regarding geopolitics. Gold also went up too, but the dollar certainly got stronger. And then the other things outside were cheaper, outside the boundaries of the United States. So we started to buy more stuff. And then the international trade became more negative. So there's certainly a trend to this. While it is always negative, it's about the degree of being negative. Now, tariffs are giving us some volatility, right? I said last week that first quarter, international trade dipped down into a negative territory we had not seen before, because everyone was loading up before tariffs went into effect. And in March of 2025, I believe, was the lowest in recent history. And now we're back up. So while the number itself is not that interesting, I think some of this context is very interesting. Now let's move on to some economic data that happened to move markets. In last week's video, I talked about some economic data I would be paying attention to. I had no idea that they were going to be moving markets, so they became actually more interesting. So the first one is ISM non-manufacturing PMI. So this is on the service side of the economy. Service is a much bigger part of our economy in the US than manufacturing, so this is very important. Disappointed. So we were expecting 51.5. So remember, anything above 50 means we're expanding. Anything below 50 means that the economy is contracting. We're expecting 51.5. What we got was 50.1. So barely expanding at all. If you think about like there may be some margin of error there, I would call that at best neutral. Now, not only did we miss on the expectations on the downside, we also fell below the long-term mean of 51.6. So over a long history of ISM, the U.S. economy clocks in on average at 51.6. So we're usually expanding, but we came in below the long-term average as well. So again, piling on the softening labor market and some worries about a potential recession, knowing that the tariff impact hasn't fully been digested by the economy, these things actually cause concern and markets fell. The other set of data was initial and continuing jobless claims. Now, I didn't mention this in last week's video because, I do pay attention to it, but it's more like checking the numbers and moving on because these are weekly numbers and they fluctuate a lot. And it's difficult to find a trend in such higher frequency data. So, it's not something worth a mention unless you start seeing something that is more interesting. And certainly last week it was interesting. So initial jobless claims is basically people who have lost their jobs and they're filing for unemployment insurance claims. We were expecting 221,000. Prior was 219,000. So definitely we were expecting that to tick up a little bit, but the number we got was 226,000. So there's surprise on the upside that is not necessarily, it's not good news. Another interesting trend is continuing claims. So these are people who have filed previously. They're continuing to receive unemployment benefits because they're not able to find a job. Now, continuing claims prior week was 1.936, so call that 1.94. We were expecting that to tick up a little bit to 1.95. What we got was 1.974 million. Again, trending in the wrong direction. And especially after the bad data from the Bureau of Labor Statistics on all of those massive downward revisions, this is just piling on top of bad news on the labor economy. So what's been interesting is, and the markets reacted to it, the markets last week were like, okay, bad news is bad news. And this continued from the labor market data that we got on August 1st. Bad news is bad news. So markets, we have to dig a little bit deeper, right? Economic activity is very, very important. But then when bad news is good news, it's because the markets are expecting the Fed to step in. If the economy looks weak, well, the Fed is going to step in and the Fed is going to say, okay, we're going to cut rates, right? And then borrowing cost goes down and the markets love it and they rally. That is not what's happening here. Why? Right? Why? Maybe it's because we can't necessarily count on the Fed to only look at the labor market data and move on the labor market data. What do I mean by that? Previously to, before the pandemic, inflation wasn't an issue, right? Inflation was relatively steady. So it wasn't a risk that the Fed had to price in because all the numbers were coming in, frankly, below 2% most of the time. So of course, labor market then is the focal point of the Fed. So any data that showed weakness in the labor market or the economy in general, the market said, well, we're bad news now. It must be good news, right? Because there are less variables under consideration. But today it's different. Now inflation is actually perceived as a risk from the Fed. And therefore, there's going to have to be a balancing act. Just because you have weak numbers for the labor market, it doesn't guarantee a Fed cut, right? So maybe this time around, bad news is bad news. So, and frankly, the Fed seems to be torn. So we had some news this week from different Fed officials. Remember Michelle Bowman? She was one of the two dissenters who thought that we should be cutting rates in July when the Fed overall did not change interest rates. She actually believes that there should be 3 cuts coming up in the rest of 2025. Well, guess what? There are only 3 meetings left in 2025. So that means she thinks there should be a cut in September, should be a cut in October, and in December. There's no meeting in November. That's a lot. That's 75 basis points if we're going at 25 basis point increments. She said that it's because she believes that they should actually avoid further erosion in the labor market. She sees the erosion. She wants to avoid further erosion. And she wants, this was very interesting, she wants to avoid the risk of having to cut by a larger amount. So maybe 50 basis points instead of 25 basis points. She sees that as a risk. And I agree, because 25 basis point is like what is accepted as the, basic increment of interest rate policy. If the Fed cuts by more than that, let's say 50 basis points, more than that, 75, the markets go, what's happening? What is the Fed seeing that we're not? And then there could be a market reaction, and it could be for nothing, but it doesn't bode well for the financial markets, right? So I do see that as a risk. I'm glad she sees that as a risk as well. The other Fed official was Mary Daly of San Francisco. She agrees that the labor market is weak, and she favors seeing interest rate cuts in the coming months. So here is another dove. Now, we did get some counter arguments from Alberto Musalem of St. Louis. There are risks, he sees, to jobs, yes, but he also sees risks to inflation. And this is why the markets are like, cuts are not guaranteed, right? Balancing is crucial, he believes, because there are risks to both sides. And he is in particular concerned about persistence of inflationary pressures from the tariffs. That a lot of it may be temporary, but on the core side, there may be some pressure there. So it sounds like he wants to err on the side of containing inflation, even though he sees some of the risks to the labor market. So there's no guarantee here. We're not just talking about the health of the economy and the labor market. Inflation is something you don't control. Again, we live in a very complex economy. Inflation is a very complex topic. It isn't like an equation where you go, okay, money supply, demand, money chasing too few goods equals inflation. That's in theory. In practice, there's a lot of stuff going on underneath. So that's been a very interesting development, certainly. And certainly the markets are smarter than the rest of us. So the markets are reacting a certain way. And we may be in for sort of a new regime where we don't react to the things the way we used to prior to the pandemic. Okay. Let's move on to a different topic. And this is a topic that even though maybe I've been talking about it every week so far, it is so important and there's so many things going on that I think it deserves our attention. And that is tech and AI. Tech and AI is at the center of a lot of things. It is poised to increase our productivity. So it has huge implications for economic growth going forward. It has huge implications for investors, because if that is where our growth is going to come from, that is where the money is going to go, right? And it also has huge implications for national security. So everyone has vested interest in seeing where this goes. So what do I want to talk about today? First, I want to talk about just how important AI is, even though I think everyone who's listening to this actually knows that. But let me break it down for you a little bit, especially because there are people who say, this is, froth. There's a lot of froth here. It doesn't mean anything. Number one, markets are sometimes just smarter than individuals. So if the markets continue to express something, we have to dig deeper and see if there is something. Okay, it does seem frothy. Valuations are, the sky's the limit right now. But if the markets continue to express the value in these tech stocks and in AI, then we have to dig deeper. And I'm going to break it down into two things, software and hardware. Software, I agree, there's some froth in there because the use cases have not been fully proven across the entire economy, right? There are certain areas where it is really useful already. And I think everyone sort of agrees that there's going to be a huge thing. Healthcare is one example. Anywhere you have data to mine, incredible amount of data, studies, papers that use language, all those things can be reduced down to useful intellectual nuggets by software, but it's not proven in other areas, right? So I think I do agree there's some froth, but that's not where the money has been going. All of this investment that we hear about, most of it so far has been going into hardware. And this is where we see real dollars going to commit, and not only just putting dollars into it, but actually effort going into it, shovels and picks actually digging dirt out of the ground to make things, and the adjacent industries benefiting from it, like real estate, construction, energy. This is real. And not only that, the government has now skin in the game because President Trump came out a few weeks ago and talked about America's commitment to data centers, right? So this is all hardware, and that is real. And where am I going with this? It's such a big thing that China wants it too, right? I think everybody agrees that it's a big thing. And China wants NVIDIA chips. So let's back up a little bit. A few months ago, I made a statement, can't remember where, but I made a statement that the trade agreement between the United States and China, it may be much ado about nothing. What did I mean by that? It didn't mean that like we were just negotiating for the fun of it and at the end nothing's going to look different. That's not what I meant. What I meant was the two sides have way too much to gain and lose, right? And we need each other. It's hard to undo a relationship that has been built over 25 years to be codependent. China has something we need, and we have something China needs. What do we have? We have the consumer base. And China is still an exporting country. Let's not fool ourselves. Most of their growth comes from being able to export, right? So they need our consumer base, access to it. And second thing they need is all of these advanced chips, right? AI chips. What do we need from China? Let's just come out with it. Rare earth minerals. So we need each other. So we can't get too far away in material terms from the current situation. But what is being worked on are the terms around it. Those are just as important as what is actually being exchanged through trade. So this is my speculation. Back in April, the Trump administration came out and said to NVIDIA, you can't sell H20 chips. This is AI chips. This is the high quality stuff. And NVIDIA was upset because China could be a very, very big source of revenue, and they knew that. Now, can we do that? Number one, NVIDIA's argument was that if we don't sell it to them, they're going to develop it themselves. Might be true. Or they're going to get it from a secondary market. It is true. And then a few months later, after some negotiations, suddenly we're saying, it's not that big of a national security, NVIDIA, you can sell those chips. That was actually a few weeks ago as well. What do I think happened? In the trade negotiations, my speculation, we'll sell you those H20 AI chips that you want so much. You give us the rare earth minerals. What's different? Nothing. What's happening is over the weekend, we learned that the government and NVIDIA, as well as AMD, struck a deal for a revenue sharing type of a scheme where the government takes about 15% of the revenue from these AI chips. They agreed to it, and what do I think about it? I'm not a huge fan of this kind of government intervention. in this type of situation, NVIDIA and AMD agreed, so they must have seen some value add to it that they wouldn't have been able to get before, which is the permission to be able to sell these H20 chips. So taking 85% of that additional revenue that they may not have had if they had a ban, okay, that seems reasonable to me. Except because the permission to sell H20 chips was already priced in to the market, to the price of NVIDIA stock. So what we were seeing pre-market today, which is when I'm recording on August 11th, is that NVIDIA stock is down, so is AMD. Okay, it's not down by a humongous amount, but it is down because the investors are not liking this. Okay, so there is some impact in the price of these stocks. This looks like a way for the Trump administration to raise money to help defray some of the deficit, the cost, and perhaps the cost of the tax bill that was extended. Remember, it's not an extra cut, it is just an extension. It's a creative way, but and we do have things like public-private partnerships. Those things do exist, but revenue sharing is kind of new, and I can't even call it a tax because it's not coming after the cost is cut out or the cost of running a business has been accounted for on the profit level. This is on the revenue side. So I think it's going to take the markets some time to digest. Okay, thanks for listening to all that from last week and some of my thoughts. Coming up this week, it's a big week actually, again, for economic data. We have the Small Business Optimism Index coming in. This is really important because there's a lot of news out there about the big businesses, the Mag 7s and the companies in the S&P 500. There's a lot of information. Everybody covers it. But let's face it, there are a lot of small businesses around the country that can tell us how they're feeling and what they're thinking. I am now a small business myself, but I'm not filling out the survey. But this is a really important survey to gauge. It's a good gauge for the American economy. The other thing that's coming up is two different data sets for inflation. The first is CPI, is coming out tomorrow. This will give us a sense of how much how price is doing for consumers, but also maybe a glimpse into how tariffs may be being passed all the way down to the consumer level. The expectation is that the month over month, as well as the year over year CPI numbers, will be slightly higher than last month's. We'll see. If you remember my video from, I think it was 2 weeks ago, I did say that there was not much to see, right, in the June data numbers. So we're getting the July numbers. We shall see. The other inflation data set we're getting is PPI. PPI is really, we don't really pay that much attention to it because it can also move around some. And a lot of what the market pays attention to is what the consumers are experiencing because we're such a consumption-oriented economy. But this time around, I think myself as well as everybody else will be paying attention to this PPI because what PPI gives us is along the production chain, how are the prices behaving? Where is it spiking? Because what we want to know is, let's say there are tariffs coming in, how is it being distributed, if at all, along the production line? Or is it going to be passed entirely down to the consumer? So remember, there's a chain, right, of production all the way down to you and me. So I'm going to use a bakery as an example because those of my friends out there know that my dream is owning a bakery, even though I don't know how to bake. I don't know why I have this dream. It's probably a romantic notion. But if I'm a farmer and I produce wheat and I sell it to, a processing center, the processing center and the farmer, if they're importing wheat, let's say from Europe, can have a deal, right? They can actually say, okay, there's some tariffs here. I'm going to cover some of this. You cover some of that. And then the processing center goes to the packaging center and says, okay, how do you want to handle this? Well, maybe we can share some of that burden. So this is the way I'm giving sort of an ideal situation where the impact of tariffs can be like distributed along it. Doesn't mean that it will, but it can, right? And then by the time it gets to the consumer, maybe I'm the baker and I say, well, the cost has gone up a little bit. I'm going to assume, a certain percentage of the cost and then pass a little bit down to the consumer. So between the importing state or importing phase all the way down to the consumer, if the production chain is pretty long, it can actually be distributed with people, everyone along the way feeling just a little bit. But nobody is coordinating this. And, depends on negotiations and whether or not companies along the way can even absorb some of this impact, right? So PPI, I think it shows us the price changes along the different points of production. I think may be able to tell us or give us a glimpse of what is actually happening to some of these price increases from the tariffs. So PPI suddenly has become very important. The last sets of data are on the consumers. Again, consumption-oriented economy, consumers are important versus retail sales. Last month, I said this 2 videos ago. Last month, retail sales came in fantastic. Even though we're expecting price increases, apparently we all went out and went shopping. We shall see if we still feel that way, especially with some pressure on the labor market. If we feel confident, we're going to go spend. If we don't feel confident, then we're more likely to save. The other thing is University of Michigan consumer sentiment. This is a preliminary number for July. We get the final number a little bit later, but that also gives us a little bit of a glimpse into how people are feeling. And again, all of these things are related. How I feel impacts how I spend money. Okay, and then how I spend money actually influences the margins of these companies, et cetera, et cetera. So this is a very big economy. It's very complex and it has great momentum, very big momentum, and its impact on industries and companies outside the US as well. So this is going to be a really important piece on the consumer next week or this coming week. All right. That's it for this week. Thanks for tuning in, and I will see you next week.